Hello, everyone, and a very warm welcome to today's major markets update for Friday, March the 24th, 2023. Here we have Count Dracula from Sesame Street. So the question is, are we going to count 3 waves up, which is corrective price action, or can we count 5 waves up? The jury is still out there, and they'll make a big difference in the ultimate outcome. 3 waves up, corrective, expect 3,000 to high 2,000s on the S&P 500 once we break below key levels made in March and before. And if we get 5 waves up to about 4,050, then we should expect the next pullback to be a low-risk buying opportunity for a nice rally into May, potentially July, based on average seasonality. Seasonality has been tracking quite nicely, but price is the final arbiter always. And it can throw this average of 95 years, or every 4 years within those 95 years, pretty quick out the window. So we should not hang our hats on it, but use it as a guideline. And if it doesn't track along anymore, then it is over. I have seen years where it tracks beautifully. Every single blip higher and lower is tracked to the T. And I've seen years where there is no relationship whatsoever. That's why it's an average and not an absolute. Remember, that's why we can never be always 100% correct and ever be 100% accurate. When the data changes, we change accordingly. We assess the chart based on the current data, and we apply the most beautiful analytical tool available, Elliott Wave, to get our reliable upside and downside targets for low risk buying and selling. Remember to always have a stop loss in place. He or she who does not use a stop loss will come out the loser eventually. Bigger picture wise, and I'll start off with that one, and we'll go into seasonality. Bottom line, so far, as said, only 3 waves up for most indexes. The NASDAQ 100 can arguably be counted as 5 waves, but the fib extensions and retraces match better with only 3. So back above yesterday's intraday high, as I said already yesterday, increases the odds for that missing 5th wave. If we get 5 up, then the next pullback will be our low-risk buying opportunity for a rally into, in my humble opinion, May, July, based on this average seasonality. Below last week's low, especially below March lows, etc., the alternate bearish count is operable with those downside targets on the charts. That would not match seasonality, but price, as said, is the final arbiter. So seasonality will throw it out the window. It's just an average. But we still have a 10-year oil Dow relationship to content ourselves with, as well as Gann. I'll show you that a little bit more. I talked about it already in the previous webcast, but I'll show you some more proof for it. And why the Supercycle 4 is laid out as it is, because it is, in my humble opinion, a copy of the 70s, where we had high inflation and high employment, and I think also the Fed raising rates and all that stuff. So you see in a moment how we try to match previous patterns with current patterns, because history repeats itself, but never rhymes, or the other way around, whatever it is. Our Elliott Wave pattern corrections we're looking for, and let's go to the charts. So the first thing I wanted to share is a tweet of mine where it said 7 books that help you understand why we currently are where we are after 2020, so to say, and why things are only going to get worse because our leaders will not and cannot do anything about it. Of course, we're on. These books I can highly recommend. Some are about COVID, but COVID itself is not the issue. It is the response to this COVID. We can all argue if it was intentionally released or not. In my humble opinion, it's not. I think there is evidence enough now that it was indeed a lab leak, which is fine. I don't care if it's natural or not. That's something entirely different. But the way we as a society have responded to it, and the way our leaders and unelected bureaucrats have responded to it, are the hallmarks of a turning point, the 4th turning. We need to break down our institutions, such as CDC, FDA, and maybe even Congress and Senates and all that stuff. Things need to change, and out of the ashes, the phoenix will rise. So with that in mind, if you understand kind of the bigger picture we're in and why things are happening the way they're happening, let's then have a look at this fantastic 10-year oil lead up versus the Dow Jones by Tom McClellan. And this is an article from 2020. I used it in my book, where he was looking for a top in April 2021. We got it into January 2020. Remember, again, this is not about absolutes. It doesn't have to be a 1-to-1 relationship with 9 zeros behind it. 6 months is nothing on a few years, okay? So eventually we'll get this crash starting 2024 to 2026. It'll be plus or minus a year. It's fine, okay? This is our bigger picture roadmap we're going to follow. And this suggests then that we're still kind of, as you can see here, bebopping around for quite a while. So it matches with the current price action, a lot of bebopping back and forth. Again, it's not about the exact amplitudes either. It is about the timing, similar with seasonality. It's not about the absolutes. This, of course, was a huge crash in oil, but it didn't reflect itself as much in the Dow Jones. It's just all about general path. So we should then top out here, 2023, etc. And eventually we should then get ourselves back on track for a larger B wave before an even larger C wave starts. So an update on that is from March 8th. 2024 is going to be ugly. Okay, so we have more price data available. So we still, of course, have the oil prices, and the Dow Jones is now starting to match it in quite nicely. And we should just bebop around here for this ugly price action and then start to crash. Okay, so that is pretty much what McClellan is seeing. 2024 is going to be ugly. Okay, shorter term, he's looking for a large cluster of bottoms, March 9 to 15. We got those. Okay, this is from March 7, by the way. And another bottom due first week of April. All right, that matches quite nicely with our seasonality. Remember, we're going to go to seasonality here. And we should have, as you see here, seasonality is somewhere late March, but it's all plus or minus. Okay, that's what we're going to look for. And then eventually we're going to get our crash into 2024. This matches quite nicely with W.D. Gunn's William, by the way, financial table. He already made this, I believe, in the 1930s, or if I'm correct, and forecasted correctly. Once the table was adjusted, his table only went out into 2008 and had to be adjusted for some planetary wobbles, whatever it is. 2020 would be a panic year, was correct. Okay, 2019 was high stock prices, that's correct. Then low stock price 2021, not really. And then 2022, high stock prices, very high. Well, we topped out already January 4th, 2022. 2023 is our current one, is neutral. And then 2024 is a major panic and a crash. So that aligns very well. Again, there are definitely years that we have missed. That is okay. It's not about exact accuracy all the time on these large time frames, plus or minus a year is fine. But if you're talking to somebody who's 80% of the time correct, you better listen. Unfortunately, of course, he passed away, but this is a roadmap we're going to use. Why this aligns 2024 very well with, of course, the oil relationship. So that brings me then to the 1970s. Okay, the 1970s was a, or actually the early 1970s, late 1960s was a tough economic time. I wasn't around back then. I'm from the early 70s as a baby, so I had no recollection whatsoever. And as you can see here, what did we do? We got a irregular expanded flat, lasted 6 years. All large fourth waves in the stock market are flat corrections. Okay, all of them. They're either regular or they're irregular and expanded, one of the two. So that's why super cycle 4 can logically be assumed to be one of those as well. This one lasted 6 years. And then if we go from 2000 to 2009, 9 years, that was a cycle 4, 1 degree higher. So super cycle 4 should assumably be 12 years, 22 till 2034. We had our initial A wave lower. We had irregular flat, meaning new all-time high for wave B. And then we had 5 waves lower for wave C, primary for 50% correction. And then the new bull started. So that brings us then to our current situation. Again, we had here a regular expanded flat primary 4 between 2018 and 2020. We had a major 4 here between 2015, 2016. Also, again, this was a regular flat. It's all flats. So we have a similar type of pattern. We draw a fictitious trend line here, based on these type of relationships, like the oil relationship, the Gann table. We kind of, start guesstimating. This is so far out, it's just a guesstimate, but you got to start somewhere. And we could have potential already topped for this wave C of B, of course. It is very possible, though I would like to see it drag on a little bit longer, again, based on seasonality, which has us, as you know, go on a little bit longer into July. But again, prices find an arbiter, we go lower, and then we throw all of this out the window. Very simple. So if we are still in wave C here, it is very possible to be determined. That is my primary expectation based on all these paths, right? You can see here oil should tell us that we're going to rise, flip-flopping, overlapping throughout the year, which is based also supported by seasonality. So we must align those type of expectations. Then I can be off, of course, by 1 wave degree, and this is a little bit more drawn out, more complex, super cycle 4. So we could still only be in wave B of A, and not in wave C or A here, a larger A wave, right? It can be off by 1 degree. Potato, it's all eventually going to end into a crash with similar type of lower prices. Nothing to worry here about. Why worry what something's going to happen in 5 years from now? We'll just simply track it and see if eventually we're right. And so far, I'm right. That's nice. We'll see how this eventually transpires. Okay, on to today's price chart. Now you know why I think the way I think and why it is based, what it is based on. It's just logic, and that's all we can do. And then we'll see if it matches yes or no. This is the daily chart of the S&P 500s, and as you can see, we're holding a 200-day moving average. We're both below the Ichimoku cloud and below the 50-day. So this is a glasses half full type of chart. I want to see it above the cloud and above the 50-day and above the 200-day. Nice thing is the MACD remains on a buy, now the 4th day in a row. Once it does that, as you can see here, etc., most of the time a significant uptrend starts. So that's a good sign. Money flow is disastrous. That's not a good sign. So this is kind of like a glasses half full setup. RSI 5 is above 50 again. I now need to see follow through. Similarly here for the NASDAQ, you can see here, this is actually a little more positive. We're above the moving averages and above the cloud, which is holding as support. And ideally, we've only done 3 waves up because we reached 161.8% extension, which is reserved for 3rd waves and not necessarily for 5th waves. 5th wave should go to this target box. If we can break above yesterday's high, 12,000, I believe it is for NASDAQ, then we can, or what is it? 11,950. Then we can target 12,100s, 12,200s for this wave 5. We roll over for our seasonality into late March, early April, and then off to the races. That'd be ideal. This is the weekly chart of the NASDAQ. I haven't shown this in a long time, but we're back above all the moving averages once again. Still below the cloud. The cloud is red. So this is now a 75% bullish chart. Okay, so this is good. And now we need to bust through the cloud. Everything is still on a buy. Everything is pointing higher. So that is good. Okay, so this is good. This is a 75% bullish chart. That's what the data tells us, and that's how we trade it accordingly. It is still a bullish chart. Then if we zoom in onto the hourly chart of the NASDAQ 100, we might have bottomed here for this wave C. If so, then that was a running flat. Running flat means wave C does not go below the end of wave A. So with A, B, and this is then wave C. Quite ugly price action. Again, if we go back above 12,900, this wave 5 should be underway. That is my primary expectation. And then I think we can target about 13,200, 13,300 to be determined. And as you can see, we filled a little bit, reaching the lower end of the target. So we could have even gone to 12,425. But so far, right here in the ideal target zone for a 4th wave. Nothing out of the ordinary just yet. But again, still only 3 waves up in my own opinion. Yes, we could count it as 5, but it'd be odd Fibonacci extensions. So I don't like it. That brings me to the S&P 500 hourly chart. Also here, overlapping 3 waves higher. We bottomed right here at the lower end of the ideal wave C target zone. Okay, I don't want to see it go below it. Below 3,900, and that's going to look too happy. Recovered back into the target zone, and if I use typical wave 5 is 0.618 times the length of wave 1 plus 3, we target about 4,045 to 4,065. Okay, so that looks pretty good. And again, above yesterday's high will really nicely bring us there. So I'm going to, there. This should be now our ideal wave 5 target zone. Okay, so we have positive divergence here on the RSI 5. That is good, and it's starting to respond quite nicely. Let's see if we can get it. Okay, as long as we hold below, above today's high, low. Sorry, so many highs and low. As long as we hold above today's low, we can move higher and above yesterday's high at about 4,010, and I'm going to look for 4,045, 4,065. Okay, so horizontal line must hold there from a short-term perspective, and then here, if I go there, that is about 4,007. Break above firm 5. Okay, there. Hopefully we get it saved, and that's great. So if we're going to look at what are other people seeing, especially on a shorter term time frame, Avi Gilbert's work, this is from March 21st, 3 days ago. I think he posted stuff 72 hours after the fact, which is great. And you can see here as well, he also says we either have only done 3 waves up or we're going to get 5. He's looking here also for 4,065-ish. So that's pretty nice. That's what we were looking for as well, 4,045, 4,065. And a downside target of about 39.12, and I think we got 39.09 today. So it is really make or break. That's why I don't want to see it go any lower than we were today. And then this wave 5 should go on for a leading diagonal. Please remember, if we are in a final C wave, that larger C wave to 4,500 can also be a diagonal. So lots of overlap to be expected. Prepare for the worst, hope for the best. So far, so good. You're seeing the same thing. It is either 3 up or it's going to extend. So we'll know soon enough. Soon enough, we should know. If we get this 5 up, then again, pull back to about current levels should be our buying opportunity, right? To about there, should be our buying opportunity, low risk for a nice run, much higher. Okay, that's our preferred scenario based on oil, Gann, based on seasonality, all that stuff. So we have a lot of good stuff aligning, but now the market needs to tell us. So we're still very early days. Otherwise, all we got was wave 2, and we're going to do 3, 4, and 5 to 32.60, potentially 28.60. That's the downside risk. Okay, so the upside reward and the downside risk if we go below the December lows. That's really the floor. It's got to hold, but of course, already below March lows, etc. Further warnings. And that's why already today's low needs to hold. IWM looks like we had a nice, not AX nice, but a classic triangular wave 4. Look at this. We bottomed for wave 3, A, B, C, for wave 4, and I think we've completed wave 5. It's a nice bullish reversal candle. Lots of positive divergence, as you can see, everywhere. So that's good. On the RSI 5, on money flow, MACD. So we have a good setup here for much higher prices. Resistance is at 178 plus minus $1 on the IW. Okay, so this is why I waited with the update on this, because as you can see, 4th waves are horrible. I thought the 4th wave had already bottomed here, but as you can see, it continued in its form, an A, and then a B, and then a C for a, I think this is a also irregular running flat wave 4, and now wave 5 should have complete nice strong reversal candle today. This is a nice strong intraday reversal candle. We break to the downside on the open, and then the whole thing gets reversed and bought up. Excellent. Semiconductors, I don't really know what to make of this mess over the last 6 trading days. This is less certain. Okay, so now we're moving to indexes that are less certain. Dow Jones also, this is still only 3 waves up, and whatever mess we got since the Federal Reserve announcement to raise interest rates even higher, while banks are already under quite a lot of stress with current interest rates. Don't tell me why, but fact remains, I'm not so certain about this one, so I'll just refrain from updating until I see some more clarity. So otherwise, we get into this routine where it is really starting to be guesswork, and that's not what I want to do. Let's look at the new lows. What do they tell us? Too high. Too high, too high, too high. Not a good sign. That's just what it is, and don't like it. So that's not in the bull's favor. How we're doing on the McClellan oscillator. Well, today we did close into the 1. Remember, some indicators might be bearish and some indicators might be a little bit more bullish. That's always eventually the weight of the evidence. If we have 10 different indicators and price charts and 8 of them are bullish, then we have to adapt a bullish stance, notwithstanding that we can still follow the bearish outlook. But that's why we have stops. Very, very simple. So we're definitely back to positive, but it's only 1. It's nothing to write home about. But from a summation index point of view, which adds yesterday's McClellan oscillator reading to that of today, which was added to that the day before, etc., that we start to see a little bit of positive divergence on the RSI 5, extremely oversold, as you can see, extremely oversold. So this one starts to suggest there is now more room for upside than there is for downside. Okay, so this one favors the bulls as well, but we have not seen positive McClellan readings that are high enough to the double digits, at a minimum, I would say 60, to help us knowing that this next wave 5 is on the way. It's the summation index. Interestingly, the PMO index remains on a buy. So that one is also bullish. Sentiment still in the doldrums. It's 53% exposure of active money managers. It's not much. Should be overexposed when we bottom and underexposed when we top, but money managers seem to do the opposite. And so are individual investors still extremely bearish. Okay, but sentiment is only sentiment. That's why I show it last. It's the last one. It's not the first one. You should hang your heads up. Maybe the third one, and then seasonality the 4th. You can argue about which one is tier 3, which one is tier 4. So that's really all I have for today. I really hope you enjoyed this update. Let's see if we can get a next top due around March 26, 27, which would be somewhere Monday, Tuesday, plus minus 2 days. Okay, we can rally quite strongly in a couple of days, depending on what news might hit the tape over this weekend. So please be aware that we are, of course, in a large bear market. Let me see if I can find the summary slide for you. There. Still only 3 up. Okay. There's lots of stuff that argues for continued rally into 2023. Price is the final arbiter, and I want to see 5 waves up. If we get 5 waves up, I think it is time to turn bullish for the intermediate term. But remember, long-term, very long-term, I have 0 indication that this is a bull run, quite the opposite. But some of the charts are improving, which is nice, and that must be taken into consideration. The daily chart for the NASDAQ doesn't look too bearish at all. We're above the moving averages, above the cloud. The weekly chart as well for the NASDAQ looks pretty bullish, 75% bullish, but we need to get above the cloud because, as you can see here on the left-hand side of the chart, this is a bull run, that's a bear run, and currently we're still in a bear environment, though things are improving. And the S&P 500 on the daily time frame has some work to do as well, which is bust above the clouds and all those good things. But we're not there yet. So please take that into consideration. In my humble opinion, this is more of a green is gone environment, both for the long as well as for the short type of trades. That's all I have for today. Thank you so much for listening. Thank you so much for being a valued premium member. And please remember, stick with it. If you survive this market, you can survive anything. This market will separate the men from the boys, the chicken littles from the disciplined and the diehards, and it is up to you to decide which group you will be at. I prefer the latter one, and I'm sticking with it. And I keep on trading the way I have been trading, and I like it. It's actually a very good learning environment. This is fantastic for once the new bull starts, we'll be miles ahead of the masses. And that is the largest advantage. Take care, trade safe, and have a great weekend. Bye.